many, buying a house is the American dream. To fulfill that dream, most homebuyers in the US make a down payment, then borrow the rest through a mortgage, usually a loan with a fixed interest rate that they pay back over up to 30 years. How much they have to pay each month is highly dependent on one thing: the mortgage rate. Because higher rates means higher monthly payments, and that influences how much house a buyer can afford. Say you want to buy an $100,000 house with a 30-year fixed rate mortgage. Monthly payments with a 6% interest rate would be around $600, but if you bought that same house with a 4% interest rate, you would only pay around $480 per month. People often focus on the average 30-year mortgage rate, but your actual mortgage rate could be higher or lower depending on your credit history, income, and other financial factors. Homebuyers may also opt for an adjustable rate mortgage. Such loans typically offer lower interest rates in the first few years of repayments than the traditional 30-year fixed rate mortgage, making monthly payments more manageable in the first few years of home ownership before the loan resets to a fixed rate. And that rate depends on, you guessed it, the mortgage rate on the date of the reset. So it's a gamble. So what moves mortgage rates? A mixture of things, including Federal Reserve decisions, inflation rates, and something called the 10-year Treasury yield. The 10-year Treasury is basically a loan investors give to the US government for 10 years, and the yield is the returns that they earn on that. Because it's considered one of the safest investments out there, mortgage lenders tend to use the yield as a benchmark when deciding how high or low mortgage rates should be. Now here's why that matters. Banks don't usually keep mortgage loans forever. They package them up and sell them to investors who then collect the payments instead. These investors compare them to safer investments like US government bonds. So when bond yields go up, mortgage rates tend to go up too, to account for the added risk of default when lending to homeowners. The hard part is that mortgage rates can change constantly because so many factors affect them day to day, which is why trying to perfectly time the market is incredibly difficult. So for buyers who can afford today's rates, they may be better off buying the home that fits their needs rather than waiting for the perfect rate.